We now get to what happens when you get to line items that are called other current liabilities or other non-current assets, right? So sometimes companies will aggregate certain items into catch-all buckets on the balance sheet, maybe because they're not material enough, or because they want to aggregate a whole bunch of things together because they're not really core to the to the operating activities or really that useful. A lot of this is about materiality. To be honest, most of this is when you've got buckets that are you've got a whole bunch of little items, and rather than having a massive balance sheet, companies will aggregate it like this. So it's always helpful to check the footnotes to see if you're going to try to forecast these. Well, you got to figure out what the nature of these items are. Does a breakout of these items exist? So for example, let me just open up Apple's 10K. And here we see other non-current liabilities. Let's actually just go to the income statement and see this item listed. And we're going to sort of reckon with this line item in a little bit when we actually get to the model. But I want to give you a little bit of a preview. So here on the balance sheet, as you guys saw, we had other non-current liabilities of $45 billion. There is a footnote that explains what's in there, right? We've got deferred, they have a tax payable, and then they've got some other non-current liabilities which they don't really get into. And so, if we know, for example, what the other line items are, then we could, go back to the exercise we just did and say, oh, this is mostly a tax payable, so we should either grow it at the tax growth rate or the revenue growth rate. But sometimes we don't know what they are, right? These items are less straightforward because they often commingle. Plus, remember, there was another item in there as well. There was something called other, and we don't know what those other are. So this makes these items pretty challenging to sort out. So as a general framework, that's what I want to provide you guys before we dive into Apple. Some items could grow as the business grows, while others may be financial assets or liabilities that don't correlate to the operating activity. So it's not as simple as some of the other items where we just grow with revenue, because some of these might be, for example, a financial asset. You might have non-current assets. In fact, for Apple, we do have that. You have some financial investments that don't necessarily grow as Apple's core revenue grows. And so we don't know, unless it tells us in the footnotes, in which case we have to make a choice. If we believe that the items en masse that are lumped within other assets, either current or non-current or other liabilities, if we believe they're likely tied to operations, meaning they will most likely grow as the revenue of the business grows, grow at the revenue growth rate. On the other hand, if the nature of the item is unrelated to operations, it's like a financial asset, some currency related financial asset or financial investment, or an investment in some other affiliate that has no necessary or fundamental connection to the operations of the business. Or if it's unclear, the amount is immaterial, right? If this is a small amount, don't worry about it and simply straight line the prior year's results. In other words, if there's, if the last historical year had, $1,000 in other non-current liabilities, and you don't know what these are, they're tiny, just keep it at 1,000, right? And the distinction between straight lining and revenue and growing with revenue basically says, I think this is tied to operations, it'll grow with the revenue, or I don't. I don't know how to grow this. It may go up, it may go down, I have no idea, so we're going to straight line. That's the framework that you should keep in your mind.